Good afternoon, everyone. Let's take a quick look at what's moving the markets today, from the US dollar and oil to gold. So starting from the US dollar, the dollar continues to drift lower in a calm trading environment. While volatility in stocks and bonds have been more noticeable lately, FX markets remain sensitive, with implied volatility for euro-dollar and dollar-yen still above 8% and 10%. This reflects worries that potential Liberation Day tariffs could come back into play in July. And reports suggest that the EU might accept a 10% tariff on most exports to the US, while the US is also pressuring Japan to open its market to American rice, helping explain why the dollar-yen led the dollar move lower overnight. And meanwhile, concerns over Trump's tax bill and its impact on US fiscal health haven't been major drivers this week. And Treasury yields remain soft and swap spreads stable. For now, the markets seem to be waiting for more concrete signals like weaker Treasury demand or rising inflation to push the dollar more decisively. So next, moving to WTI crude oil. Oil prices have been under pressure, with WTI sliding back to $65, now down over 17% from the peak from last month. And US crude production hit a record of 13 million barrels per day in April, but this may mark a temporary peak. Active rig counts have dropped 9% since April, and many shale producers actually need price above 65 to 70 to stay profitable. While oil briefly surged above 75 during the Middle East tensions, it has since reversed sharply. And OPEC is pushing to regain market share, and the US has postponed strategic reserve purchases, taking away a key source of demand. With drilling activity slowing and price low, a rapid rebound in US production seems unlikely in the near term. And last but not least, gold. Gold prices have climbed near 25% this year, driven by policy uncertainty and rising geopolitical tensions. And strong ETF inflows pushed investment demand to the highest since 2022, and central banks continue to increase their gold reserves. Looking ahead, demand should stay strong, with price potentially rising another 10% in the second half of the year, leading to an estimated 35% annual gain in 2025. And some moderate pullback is possible next year as uncertainty eases, but the overall trend still looks positive. And meanwhile, expectations for the Fed rate cut and fiscal worries, including Trump's Big Beautiful Act, may continue to support gold in the near term. So overall, the markets remain cautious as they weigh policy shift, trade developments, and inflation risk. We will keep watching these moving pieces closely in the days ahead. And thank you for tuning in, and trade safe.